So now we want to determine the free cash flow to the firm that will be used to determine our discounted cash flow analysis for Amazon. So in this case, we will bring in the operating profit. So the operating profit in this case is going to be the earnings before interest and taxes. So we can go all the way to the income statement, and we can grab here the operating profit, that is the earnings earned before income and taxes. So we grab that here. And we can also grab the depreciation. We can grab that from the cash flow statement. So we have that here. We can fill all of these to the end of the projected period. So having done that, we just want to estimate the EBITDA including stock-based compensation and the EBITDA excluding stock-based compensation. The reason why is because stock-based compensation has a significant impact in determining the free cash flow to the firm. So while it is a very large amount, it could cause a significant impact in our cash flow. So we will have to exclude stock-based compensation by adding it back so that we can use that to determine the free cash flow to the firm. So in this case, the earnings before interest and taxes, depreciation, amortization, including stock-based compensation, is going to be the sum of those. We can take all of these and fit it to the end of the projected period with Control R. So we have that set up there. So what next we want to do is to bring in the stock-based compensation. So we have to add it back so that we are excluding it from EBITDA. So we go to the cash flow statement and we grab stock-based compensation. So EBITDA excluding stock-based compensation, we take the EBITDA including stock-based compensation, and then we add stock-based compensation in order to exclude that from EBITDA. We can fill this to the end of the projected period with Control R. So having done that, let us begin now determining the free cash flow to the firm. So we'll begin with the operating profit. So the operating profit in this case we consider to be the earnings before interest and taxes. We have that in place there. So to determine the unlevered taxes, it's going to be equal to, let's switch the sign, we take the operating profit, I will multiply that by underscore tax rate. So we have that in place there. So now to determine the net operating profit after tax, we can sum all of those. We can take this and fill this to the end of the projected period. So we have now no part, that is the net operating profit after tax. So we have to account for other non-cash items again to come up with the free cash flow to the firm. So we have to adjust the net operating profit after tax by the depreciation, stock-based compensation, other non-cash expenses, capital expenditures, and the changes in net working capital. So we're gonna bring in depreciation from here. Again, we'll bring in stock-based compensation. Then we'll also bring in here other non-cash expenses. So we grab that from the cash flow statement under the net. We grab that from the cash flow statement under the operating activities of the cash flow statement. So other non-cash expenses, you can grab that from here. Also, remember we consider these non-cash expenses as the changes in marketable securities. So it's a non-cash item. So we are essentially deducting any increase in those changes there. So any increase in marketable securities is gonna be a negative impact. So it's a cash outflow. So that's why we have it right there set up like that. And if we have the expenditures, we can just switch the sign